Welcome to the Explainer. Today, we are tackling the ultimate scoreboard for business survival, the income statement. Let's dive right in. So, I want to kick things off with a bit of a plot twist. How on earth can a company with a $10,000 profit go completely bankrupt? I mean, it sounds like a total paradox, right? If you're making money, you should be doing great. But, in the business world, things are absolutely not always what they seem on the surface. We're going to solve this little mystery together today.
Here's our roadmap for this explainer. We'll hit the business scoreboard, uncover why profit is not cash, break down the 3 levels of profit, practice reading the income statement, and finally look at making smart business decisions.
All right, Section 1, the business scoreboard. Why we need accounts to survive. Picture this. You're launching a custom fashion brand. You're out there buying rolls of fabric, you're hiring staff, making sales left and right. Now, imagine writing absolutely none of it down. It's a bold strategy for sure, but honestly, it's a total disaster waiting to happen.
Without proper accounts, you are literally flying blind. First off, you won't even know if you're actually turning a profit or a loss. Second, the tax collector has no idea what you owe, which pretty much guarantees massive fines. Ultimately, without these records, your business is headed for some incredibly deep financial trouble. Now sure, modern accountants use software to handle all this in seconds, but the fundamental reality hasn't changed. You absolutely have to keep score.
Moving on to Section 2, profit is not cash. This is the golden rule of business.
Okay, remember that question about a profitable company going bankrupt? Well, here is the exact scenario. Let's look at Good Hope Enterprises. They sell 10,000 calculators for $3 each, but they sell them on credit, meaning the customers haven't actually paid yet. Meanwhile, those calculators cost Good Hope $2 each to buy from their supplier, and they paid that supplier immediately in cash. So, doing the basic math here, they made a cool $10,000 profit on those 10,000 units. So, where's the money?
The shocking reality, their actual cash flow is negative $20,000.
Let's break that down. Their revenue is 30 grand, but because they gave their customers credit, $0 actually entered their bank account. Meanwhile, to get their hands on those calculators, they had to pay out $20,000 in cold hard cash to their supplier. So what you get is a $10,000 paper profit, but an actual cash flow of negative $20,000. This right here is exactly how companies go insolvent. You just can't pay rent or utility bills or your staff with a paper profit. You need cash. High profitability absolutely does not guarantee you have cash in the bank.
Section 3, 3 levels of profit, or what we call the profit funnel.
Think of this as, like a giant funnel. Step 1 is gross profit, which looks purely at the profit from buying and selling your core products. Step 2 is net profit, which is what's left after you deduct all your general business overheads. And finally, Step 3 is retained profit. That's the actual amount the company gets to keep and reinvest at the very end of the day. Let's walk through each one of these.
Let's demystify Step 1, gross profit. Imagine City Cafe Co. sells soda for $2 a can, and they buy them for $1 each. Now to find the true cost of sales, you have to account for inventory. They started with 200 cans, bought 1,500 more, and ended the year with 300 cans just sitting in the stockroom. If you add the opening inventory and purchases, then subtract that closing inventory, it reveals they actually sold 1,400 cans. Now, 1,400 cans sold at $2 each. That's $2,800 in revenue. The cost to buy those specific 1,400 cans was $1,400. Revenue minus the cost of sales gives us a gross profit of $1,400. Remember, it's purely trading profit. We are completely ignoring things like rent or electricity for now.
Moving further down the funnel to Step 2, net profit. Here, we have to subtract expenses and overheads from that gross profit. Overheads include your typical stuff, rent, advertising, salaries, but there's also a bit of tricky jargon here, depreciation. So depreciation is just the fall in value of fixed assets. Think of your delivery truck or your business laptop losing value over time due to age and wear. Even though you aren't paying cash out every single year for that laptop, it is losing value, and that loss gets recorded as an annual expense on your income statement.
Finally, we reach Step 3, retained profit. Now, your net profit is still not yours to just keep. Sadly, for limited companies, you've got to pay the taxman first. Corporation tax is a percentage of your net profit that goes directly to the government. Then you have to reward the investors who took a massive risk putting their savings into your business, and you do that by paying out dividends. It's only after tax and dividends are paid that you actually arrive at retained profit, the money that actually stays in the business to fund future growth.
Section 4, reading the income statement. The scoreboard, officially revealed. Let's put this funnel to work using ACE Engineering's 2018 statement. Okay, so they start with a massive top-line revenue of $1.25 million. Great! But after deducting the $900,000 cost of actually making those goods, their gross profit drops down to $350,000. Then they pay $155,000 in general business expenses, which brings the net profit down to $195,000. After taking out $35,000 for corporation tax and rewarding shareholders with $120,000 in dividends, what's actually left? A retained profit of just $40,000. The crucial takeaway here is watching how a giant top-line revenue gets squeezed at every single level until you finally see the true earnings kept by the company.
Section 5. Making smart business decisions. Playing to win.
Let's look at a quick case study. Asif wants to open a new retail shop, so he creates forecasted income statements for 2 potential locations. Now, looking purely at the math, location B is the clear winner, right? It generates a higher revenue, and hey, even with higher rent and expenses, it leaves Asif with a net profit of $12,000, compared to just $9,000 at location A. If business was just a calculator, the decision is already made.
But a smart manager always looks beyond the math to non-financial factors. If we look at the context, location A has less competition because a competitor just closed up shop. However, location B's rent is locked in and fixed for 5 whole years, providing amazing long-term stability. And on top of that, there's a new housing estate plan nearby which pretty much guarantees a future influx of customers. The income statement gives you the financial baseline for sure, but these real-world, non-financial factors are what complete the picture for a brilliant business strategy.
Okay, before we wrap up this explainer, it is time for the ultimate challenge. I want you to test your brand new knowledge on a real-world scenario. Sue is deciding which of 2 computer games to launch, and the catch, she can only pick one.
Here are the forecasted stats. Game A is expected to sell 3,000 units at a price of $5. The cost of sales is $1.50 per unit, and operating expenses are $4,000. Now, Game B, which is aimed at teens, will sell fewer units, just 2,000, but at a higher premium price of $10. Its cost of sales is $3 per unit, and the operating expenses are higher at $9,000. I want you to take a moment, seriously, maybe even pause the explainer right here, and calculate the gross profit and net profit for both games using that funnel we just learned about.
So, based on your calculations, which game should Sue launch? Does she go for high volume and a low price, or lower volume with a premium price tag? Run the numbers on the scoreboard, weigh those non-financials for the different target markets, and you make the call. Thanks so much for joining me on this explainer, and until next time, keep calculating.